Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some bulletin board hero stocks on Friday the 21st of November. Starting off with Fitbug, where there's been a wild week here for the price action. The key point to note here as we go into the end of the week is the way that despite the flush out for the shares from 25 pence plus, they did not fill the gap down to 6.1 pence, which was really the driver of the big rally of the start of this week. This should allow us to give the benefit of the doubt to the buy argument, especially if we see a decent end of day close back above yesterday's intraday peak, which was 19.85 pence. That would take the shares obviously back towards a test of 25 pence plus and possibly even as high as 35 pence. At this stage, only really back below the 12.5 pence former 2010 peak would be a sort of warning sign that all is not well intraday. You're watching out for that, and obviously a gap fill or a break below the gap at 6 pence really would end the prospect of a sustained rally here in the short term. Next up is a stock which has been bubbling under for quite some time, GCM Resources. Looks quite encouraging in the sense that we've seen a break above the 200-day moving average on quite a comprehensive basis. There's a rising trend channel here from earlier in the year with its base around the 20 pence level, a wide rising trend channel. And the promise is that at least while we're above the 200-day moving average at 22 pence here shown in black, there could be a retest of 35 pence plus August resistance over the next month or so. Any weakness towards the 200-day line currently regarded as a buying opportunity. Also in focus at the moment in quite a big way is Nighthawk Energy. Obviously you can see this sharp rebound that we've had, which is actually a bear trap rebound from below the former March support around the 7 pence mark. Normal rule is that while we remain above this recovered support, we can regard the shares as being bullish. On the upside, initial target 200-day moving average at 10.1 pence, and ideally over the next 1 to 2 months, a fill of this gap towards 13 pence would be the favoured scenario, and really probably much more if the power of this bear trap actually starts to kick in a decent way. The overall progression here is really a sort of a trend channel which has been in place since March, and that also has its top towards the 13 pence level. Finishing off with the stock of the year, maybe stock of the decade in terms of the shorting story that we've learnt about in yesterday's Financial Times video. The charting position is that we've got a rebound off a June support line. There was the prospect once the shares gapped down quite violently below £1.20, which was the key support zone earlier this month, that there could be a dive towards below the 50 pence level. That has been seen. The question now is whether there will be enough of a dead cat bounce to get the shares back over the £1 level and perhaps towards a lasting recovery. At this stage it looks obviously rather difficult, but what you can see here in the RSI window is there has been a double rebound off this line of support from November. Normally double rebounds are decent buy signals, and at the very least what I'm probably looking for a fill of the gap towards the 70 pence level, which also ties in with the 10-day moving average at 71 pence. That's the second gap after the initial one, which broke the £1.20 level support. That's it from me. More updates at spreadbetmagazine.com.